While everyone was staring at the XRP price chart this week, something happened on June 29th that almost nobody explained correctly. Ripple quietly opened testing on a completely new layer of the XRP ledger, and a developer at the company posted 4 words that describe exactly what this means: represent, move, trade, finance. 4 stages. The first 3 have been live for years. The fourth just entered its final countdown to activation. And if you understand why that fourth word is the one that changes the architecture of everything built on this ledger, you will read this week's news very differently than most people currently are. Let me be clear before we get into this. Nothing here is financial advice. This is an analysis of on-chain data, published engineering specifications, and verified institutional activity. If any of this shapes how you think, that is valuable. If you act on it, you are doing so as your own decision maker. Let's open the curtain on what most coverage is missing. Here is the hard truth about how most people are reading the XRP ledger's real world asset growth right now. They see a number. The network crossed $5 billion in total RWA issuance and ranks 4th globally in tokenized assets, according to RWA.xyz, and they treat it as a destination. It is not a destination, it is a waypoint on a very specific architectural roadmap. And understanding that roadmap tells you why the technical event that happened on June 29th matters far more than the number itself. To understand it, you need to understand how any serious financial network actually gets built, because it does not happen all at once. Every durable financial infrastructure in history has followed the same 4 steps. Step 1, represent value. Give assets a digital form that can be verified. Step 2, move value. Build the settlement rails that carry those assets across borders instantly at minimal cost. Step 3, trade value. Create the market structure where those assets can be exchanged with price discovery and liquidity. Step 4, finance value. Build the credit layer that lets those assets become working capital, collateral, and yield-generating instruments rather than static inventory. The XRP ledger completed steps 1 through 3 over more than a decade of production-level operation. On June 29th, Step 4 entered its governance vote for mainnet activation. Jasmine Cooper, head of product at RippleX, put it exactly this way: represent, move, trade, and now finance value. That 4-stage model is not promotional language. It is a precise description of what separates a network that holds assets from a network that powers a capital market. Here's the competitive context that makes the 4-stage model matter beyond just this one network. Visa is currently settling stablecoin transactions across 9 different blockchains at a $7 billion annual rate, and that figure grew roughly 50% in a single quarter. Ethereum still holds 52.8% of tracked tokenized asset value globally, around $17 billion out of a $33.5 billion distributed market. But Ethereum's 90-day RWA inflow figure of $1.6 billion is now being outpaced by the XRP ledger's $1.9 billion in the same window. This is not a story about a single network winning a race. It is a story about which networks complete all 4 stages first. A network that can represent, move, and trade tokenized assets but cannot finance them will accumulate represented value but not velocity. A network that can finance assets can turn a custody record into a credit facility. And that is what institutions are actually building toward, not just tokenization as a record-keeping exercise. Now, let me show you the math that tells you why these stages are sequential requirements, not optional features. Think about what it means that an estimated $27 trillion in banker capital sits idle in pre-funded accounts around the world right now. That figure, cited consistently across industry sources and referencing McKinsey's correspondent banking research, represents the dormant cost of a payment system built on a simple problem. If your bank in New York needs to send money to a bank in Singapore tomorrow, you cannot physically move dollars overnight. So your bank pre-funds a checking account at a Singapore institution, a Nostro account, and lets that money sit there unused, earning near zero returns until a payment needs to flow through it. Scale that model to every bank in every currency pair in every country, and you arrive at roughly $27 trillion in opportunity cost, capital that earns nothing when it could be deployed in loans, investments, or productive use. JP Morgan alone maintains an estimated $15 to $25 billion in Nostro accounts globally, according to correspondent banking analyses, capital tied up solely to make payments flow. The XRP ledger's on-demand liquidity model attacks this specific inefficiency. Instead of pre-funding, a payment provider converts local currency into XRP at the moment of sending, transfers it across the ledger in 3 to 5 seconds, and the receiving side converts XRP immediately into destination currency. The Nostro account is replaced by a live bridge asset. That is the economics of step 2 applied to a $27 trillion problem. Now, here is where step 4 becomes a structural requirement rather than a product feature. If you have tokenized a government bond on the XRP ledger, you now hold a digital asset. Under the old model, that asset just sits there. It cannot be lent. It cannot be pledged as collateral. It cannot earn interest while it waits. You have moved from paper to digital, but you have not moved from static to dynamic. The lending protocol designated XLS-65 and XLS-66 in the XRPL's technical specification process closes exactly that gap. XLS-65 creates single asset vaults, pools where institutions deposit a single asset, whether RLUSD, XRP, or tokenized treasuries, and receive vault shares in return. XLS-66 builds the credit mechanics on top. Fixed term, fixed rate loans with off-chain underwriting and on-chain execution. RippleX developer Edward Hennis described it as real credit, not a DeFi gambling pool. The design is deliberate. Credit risk assessment stays with the institution. The blockchain enforces the mechanics: origination, interest accrual, repayment schedules, default conditions. No smart contract overrides. No automated liquidation cascades. Compliance checks gate entry to each vault through the ledger's existing permissioned domain architecture. A bank's risk team decides who gets a loan. The XRP ledger makes sure the terms get honored. As of this recording, the validator vote to activate XLS-65 and XLS-66 on mainnet sits at roughly 20 to 23%, with 7 to 8 of 35 trusted validators having voted yes. The activation threshold is 80% sustained for 2 consecutive weeks. That gap matters, and it would be intellectually dishonest to present the lending protocol as a done deal before the vote completes. What it is precisely is a mechanism that cleared a Halborn security audit with no critical flaws found, opened a $200,000 Immunify bounty program for independent security researchers, and is now in DevNet testing, available for institutions to build integrations against before mainnet activation. That sequence, audit first, test environment open to all, validator vote active, is how you build institutional trust in a protocol upgrade, not how you rush one through. Now, let's talk about the institutional picture that is already visible because the credit layer is the future. The inflows are the present. Over the past 90 days, the XRP ledger recorded $1.9 billion in net real world asset inflows, the highest of any blockchain network globally in that window, according to RWA.XYZ data, ahead of Ethereum's $1.6 billion and Stellar's $1.4 billion. That flow measurement is net, meaning new capital arriving after outflows are subtracted. At the same time, RLUSD's on-chain stablecoin market cap on the XRP ledger crossed $907 million with 30-day transfer volumes rising nearly 91% to $4.86 billion. When stablecoin volumes and RWA inflows both accelerate together on the same network, that pattern typically signals something specific. Institutional participants are using the stablecoin as settlement rail for the tokenized asset activity. The two numbers are not independent. They are cause and effect. Here's the other number worth sitting with, the one that does not appear in most RWA coverage. The XRPL's $5 billion in total represented assets includes approximately $360 million in distributed asset value, meaning assets actively moving and settling within decentralized protocols. The balance, roughly $3.6 billion, is represented value, assets recorded on the ledger for tracking, compliance, or structural representation, but not yet moving at high frequency. This distinction matters. A network at step 3 of the 4-stage architecture will look exactly like this: large represented value, smaller active distributed value. Because without step 4, there is no mechanism for those assets to become working capital. Lending changes that ratio. An institution holding $500 million in tokenized treasuries on the XRPL today has $500 million in static inventory. With XLS66 active, that same institution can pledge those treasuries in a vault and borrow RLUSD against them for short-term payment liquidity, or lend their holdings to payment providers who need 30-day credit facilities to bridge cross-border settlement windows. Static inventory becomes working capital. Represented value becomes distributed velocity. Ask yourself this: does a firm like Ondo Finance, which executed the first cross-border, cross-bank redemption of tokenized U.S. Treasuries on the XRP ledger this past May, alongside JP Morgan's Connexys platform and MasterCard, participate in an infrastructure pilot because they are experimenting or because they are pre-positioning for a specific use case at a specific institution's request? Institutional grade firms do not run production level pilots on networks they have not already committed to at the compliance and infrastructure level. That trade took 5 seconds. It replaced a process that traditionally takes 1 to 3 business days. The efficiency ratio is not incremental, it is architectural. Franklin Templeton launched its Franklin XRP Trust on NYSE Arca alongside a tokenized lending and trading collaboration with Ripple and DBS Bank, one of Asia's largest institutions. Guggenheim and Vert Capital are issuing tokenized fixed income products on the ledger. Archax committed to bringing institutional assets on-chain at the ledger level. These are not pilots waiting for permission. They are production deployments waiting for the credit layer that makes their assets dynamic rather than static. I know what a portion of you are thinking. You have been watching infrastructure get built on this network for years. You have seen the RWA number go from $50 million to $5 billion in roughly a year. a 100 times increase that a Ripple executive named Luke Judges acknowledged publicly and framed as the beginning of another 100 times cycle rather than a peak. You have watched all of that infrastructure accumulate while the price chart refuses to reflect it. And you are wondering whether the credit layer is just the next item in an endless list of almost there developments that never actually move the needle. That frustration is completely valid. Here is the structural answer, not an emotional one. Price moves when the marginal institutional buyer makes a decision. That decision is made not at the point of infrastructure announcement, but at the point of infrastructure completion. Right now, institutional compliance desks can approve XRP ledger settlement activity. They can approve RLUSD as a settlement asset. They cannot yet approve a lending facility that does not exist on mainnet. XLS 66 activation is not another feature in a long list. It is the specific mechanism that converts the $3.6 billion in represented assets from inventory to capital markets infrastructure. The represented asset number tells you how much institutional trust has already been placed in the ledger. The lending protocol activation is the event that lets that trust translate into active deployment rather than passive positioning. The Clarity Act, which remains the most significant external catalyst for U.S. institutional participation, also feeds directly into this architecture. What the credit layer needs is not just technical activation, it needs regulatory certainty that allows U.S. institutions to use tokenized assets as collateral under their existing compliance frameworks. A federal commodity classification under the Clarity Act removes the last structural barrier for institutions that are currently positioned at the lending protocol's perimeter but not yet through the gate. Think about what that convergence looks like when it completes. The XRP ledger has $5 billion in represented assets today at step 3 of a 4-stage architecture. With the lending protocol active and federal regulatory clarity in place, those same represented assets become eligible for institutional credit facilities. A tokenized treasury held on the ledger becomes collateral for a 30-day payment liquidity loan. An institution's RLUSD reserves in a single asset vault become a yield-generating instrument deployed to payment providers who need cross-border settlement bridging. The represented asset number does not need to grow for the velocity to increase. The architecture completing is what converts static inventory into dynamic capital. That transition does not happen gradually. Network effects of this kind typically move in steps, not slopes. When a credit layer becomes usable, the institutions already positioned with tokenized assets on the ledger do not wait to begin deploying them. The infrastructure is already there. They are waiting for the switch. The window to be positioned before that switch flips is the specific window we are in right now. The validator vote is live, the DevNet is open, the audit is clean, and the institutions building against this protocol on DevNet today are the ones who will be first to deploy when mainnet activates. History does not reward comfort. It rewards those who are paying attention when the room is still quiet. Here is what the pattern actually shows when you step back from the noise. The XRPL hit $1.9 billion in 90-day net RWA inflows, the highest of any global blockchain network in that window. The lending protocol cleared a third-party security audit, opened DevNet testing, and entered the validator governance vote that must complete before mainnet activation. RLUSD has surpassed Ethereum in on-ledger stablecoin market cap on the XRP ledger, and its 30-day transfer volume has grown nearly 91% in a single month. Institutional issuers from Ondo to Guggenheim to Franklin Templeton are in production, not in pilot. The four stages of the network represent, move, trade, and finance are three complete and one in final activation sequence. The question is not whether this infrastructure is being built. The question is whether you understand the architectural stage it is currently in. The signal is clear for those who are actually looking. After everything we covered today, what is the one development from this week that changed how you understand this network's trajectory? Drop it below in one word. If this breakdown gave you a clearer framework than the price chart does, hit like. It helps this reach the people who need it. And if you want the update the moment the validator vote clears 80%, you know what to do. Stay informed, stay positioned. I will see you in the next video.